Hi, and welcome back to the LLQP video series presented by Business Career College. I'm Jason Watt, and for the next 10 minutes or so, we're going to be talking about term life insurance. Now, you've already seen a little bit of an introduction to term life insurance when we looked at the overview of life insurance products. Hopefully you've already read this in your textbook, but we're going to just spend a few minutes here talking about term life insurance. Now, term life insurance is a fairly straightforward product. A lot of what we see in the way of term life insurance really didn't develop until post-World War II, prior to really the baby boom generation, or prior to the types of retirement people started to do in the days after World War II. We didn't really have a need for term insurance with all of the various iterations we have it in today. But today, with people living longer and having retirements, now retirement savings is a lot more of a concern. People generally have larger debts than they ever had in the past. And because of all of these things, term insurance is a valuable product today. Now, term insurance is pretty simple. And I've drawn here a grossly oversimplified mortality table. We could graph out mortality just in this way. If you look at in the early years, you're going to have a low cost of insurance increasing over time. So with a term insurance product, the most basic term insurance product, a one-year term product, you would acquire your term insurance and it would run out at the end of 1 year. The pricing would be based on your attained age. The next year, you could go back and reacquire that term insurance. There's almost no opportunity today to actually buy this kind of product. You will find, outside of specialty markets where we're insuring people for travel to very dangerous parts of the world, you won't find typically this type of thing done anymore. But it still provides the basic model for term life insurance. And what we see then is you buy this 1 year non-renewable term insurance products. Okay, great. At the end of the year it runs out. It's not really suitable for most clients. So instead, what insurance companies have done is they've built in a feature called renewability. So with this renewable feature, you can go from one term to the next without having to provide evidence of insurability. So at the end of the term, you go to the next term, no evidence required. And so on, you just keep moving from term to term, and so on. But for most people, a 1 year term is really not ideal. A 1 year term means that next year your cost is going to increase, and the year after that your cost is going to increase. Put yourself in the shoes of the client who's told, I'm going to sell you something, it's something you need, but every year the cost is going to increase. Well, maybe that's not for me. I don't know if I can handle increasing costs. My pay doesn't really increase by that much every year. So what am I going to do? Well, how about this, client? And these are the types of changes now that we started to see in the days after World War II, in the years after World War II. We started to see these changes where we would have maybe 5 years lumped together. So you would pay a level premium for 5 years. And then at the end of that 5 years, if you wanted to keep going with your insurance, no problem. We would allow you to renew and take that insurance for another 5 years. And then that would go for 5 years. And at that point, you could renew again for another 5 years, and so on. And as discussed earlier, there would be some point at which you would no longer be able to renew, maybe at age 75. So the product runs out at age 75. Maybe 80, maybe 70, who knows? Now, 5 years is good, it's better than 1 year, but if you're thinking about your mortgage, for example, well, you're going to be in your mortgage for longer than 5 years. If you're buying term insurance for the purpose of covering off a mortgage, a 5-year term is probably not great. You're going to have 4 increases in price over the life of a typical mortgage. So why don't we draw that thing out a little bit? How about we extend this so that we average out the cost over not 5 years now, but 10 years. So we might do something like this. And then at the end of that 10 years, if you want to carry your insurance for another 10 years, we would take the next 10 and average that cost together. That works. And today, we even see some insurance companies that have done 20-year terms. In fact, it's a very common product today. So with a 20-year term, we would take 20 years and average the cost for that time. And now the nice thing about a 20-year term is your cost is nice and predictable for a good long time. Of course, it costs you more initially than it would have to buy that 5-year term, but you're not going to have an increasing cost on a regular basis. This is likely going to give you enough insurance to cover out until your mortgage is a fairly small amount. And at that 20-year mark, you can decide whether you want to renew the coverage, that is, whether you want to go to the next term, or whether you want to drop the coverage or somehow modify the coverage. The modification options vary from insurance company to insurance company. There's no standard rule for that. Now, at some point during that term coverage, you might even decide you want to convert your coverage into permanent coverage. Anytime we come across that idea of conversion, it means that we're converting to another sort of insurance product. In this case, we'd be converting from an individual term policy into an individual permanent policy, normally to universal life or whole life. And that conversion is done without any evidence of insurability. So the insurance company said back here, we're happy to take on that risk. We're even happy to take on that risk if you decide that you want to convert into a permanent product later on. Even if you get sick over here and you want to convert over here, that's fine. You bought back here, and that's the risk we took on. We don't care that you got sick here. Okay? So now, we have this term insurance in place. You get to the end of your term. You can renew if you want. You can convert at some point. You might wait till you're 75. Just let the coverage lapse at that point. With most term policies, you'll find that there will be some deadline for it, some point at which you can no longer carry on your coverage. Age 75 or 80 is fairly common today. We even find today some insurers who've gone beyond a 20-year term. A couple of insurers are already offering 30-year terms. There are a couple of insurers who offer a pick-a-term product where you could buy a term to exactly match maybe the number of years left on a mortgage, as an example. So that's really term insurance. The structure is simple. There's no cash values associated with it. There's nothing to it except paying the cost of insurance plus a little bit of expenses. The insurance company has estimated what their needs are based on mortality tables, and they're going to collect really just enough premium here for them to make a little bit of profit and to pay the cost of the death benefits that arise during the time that they have these folks insured. Now, there are a couple different death benefit structures available with term insurance, 3 of them in fact. The most common by far is a level term structure. A level term structure, you buy your term insurance, you buy a $250,000 term policy, and that's always what you have. An increasing term policy is relatively rare. There are not a lot of companies today offering an increasing term policy, but an increasing term policy or increasing death benefit within a term policy would see your death benefit increase usually to keep pace with inflation where it's done. So it keeps pace with inflation. You would have maybe 250 this year and 255 next year and 270 next year and 280 and so on. Your death benefit would always keep pace with inflation. Of course, your premiums would increase with that type of product. A decreasing term product is actually very common. It's not sold very much on an individual basis, but lots of people will buy a decreasing term product when they acquire their mortgage. So you buy a mortgage, you know that you're going to have a decreasing need for insurance over time. At the same time, you buy a death benefit that's going to decrease at the same pace as your mortgage. Bank-sponsored mortgage insurance, which is not individual insurance but rather a group creditor product, but that bank-sponsored product is a decreasing term policy. So who buys term insurance? Well, term insurance is so inexpensive that it is the most common type of insurance sold. You'll find that probably the majority of your clients will have some term insurance somewhere in their portfolio. And the reason that it's so common is because it's inexpensive. People buy term insurance for a number of reasons. They buy it to cover off a debt. They buy it to cover off a short-term need for insurance, such as the need for insurance that a family would have when mom and dad are in their 20s or 30s, the kids are relatively young. We know at that point that we need a fair bit of coverage in place for the next 20 or 30 years. We buy enough insurance to match that period. We buy a large amount of term insurance, and maybe we buy some permanent insurance to go along with it, but the term insurance is going to fill most of the family's needs for that period. If you're not looking for any kind of investments, you don't need any kind of tax-deferred growth, you have limited disposable income, you have a short-term need, those are all the situations where term insurance is most often used. So there's not much complexity to term insurance, but you certainly have to know this product. It will be something you'll deal with day in and day out. It's such a common part of the insurance industry. Everybody touches on term insurance at some point along the way. Good luck with your studies. I hope that this has made sense to you, and I hope that you are able to join us for a future video in the LLQP video series. Thank you very much.